I understand Rest Super has 0% fees on its indexed Australian and overseas shares options. What extra risks does this pose, and should I be wary regarding investing in such a scheme given the recent super scams? They basically say, we give you the index return, but there's no fees, and you get the returns for no management fee on that investment option.
If this is your option and this is what you want to invest in, I'm not thinking it's overly risky from a dodgy perspective. Rest is a huge brand. Macquarie is a huge brand. They're both very regulated.
Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma, Mitchell, how you doing?
I'm doing great. Thank you, Owen. Rask, how are you doing?
Good. I'm glad to be back and promoted into the hot seat after Lexi, I'd say filled in, but really she probably calls the shots. So I'm glad to be back in the hot seat and answering questions today. With you, we've got questions about, what do we got here? About this thing called a True Index. We'll explain what that means. How long is too long for my financial advisor to do something for me? What happens if I do the FHSSS, the First Home Super Saver Scheme, and my life changes? We're going to answer that. And also, what's the cost of opening your front door? But enough of that. What have you been doing this past week?
This has been a busy week. Few financial advice calls, which is always fun. Lots of content. So I've recorded lots of videos this week, short content, so that'll be going out. Just been hanging around doing the usual. But some exciting stuff happened in super announcements this week. Which I predicted. If anyone's read my book, I read a book. But there's actually an error in it. I don't know if I should admit this, but I actually wrote in the book that super payday was already in place. Like, you get your superannuation paid with your pay in line with your pay cycle, which it actually hadn't come in yet, and it's coming in the 1st of July. So that has just been passed, and now my book is more correct. So now
you're factually accurate. So basically what you're saying is you predicted the future.
I did.
For maybe like 10 months, you kind of look incorrect, but really people just haven't caught up with where you're at.
Yeah, I was just ahead of the ball game. So for anyone that doesn't understand what that means, right now superannuation only has to be paid at a minimum per quarter. So your employer takes it and just holds on to it until each quarter, and then they have to make that payment into your super fund. But from next financial year, this will actually be going every single pay. So this is a huge win, because it means, our best friend, compounding interest, can do its thing. It's more dollar cost averaging. So this is a very good thing. You're going to hold on to your superannuation for longer, which is great.
Cool. And for any of the employers in the room, another heart attack for you to contend with, but that's okay. Once you're in the mood, like I know what this is like. Once you're kind of in the groove of paying it monthly, it'll probably just seem like anything else. So
surely it's better for cash flow. Like, imagine, I'm thinking from a business perspective, every quarter having this lump sum that I need to get rid of. Surely from a cash flow perspective, like fortnightly, it's going to be
most businesses though, like there's 2.7 million businesses in Australia, and 2.6 of them are small. And I'd imagine that most people are like hand to mouth kind of business owners, and they're just kind of like tradies or business owners that kind of have to manage their cash flow extremely carefully. And so the adjustment from quarterly to monthly is going from, like, imagine you're at June 30, 2026, and you're like, holy heck, I still need to pay the 3 months, but now I've got to go monthly as well. That's like 4 months in one go. So that adjustment's going to be pretty painful for a lot of business owners. So hopefully there's some support around that. But the ATO typically doesn't like to mess around with super. So we'll see. But it's a good thing. And what else is making news? I know you've done some property maneuvers recently. So how's that treating you?
I have. I'm nervous to talk about it because I don't want to jinx it. But yes, I've talked quite openly that I'm a rent investor, but I have bought a primary residence and it's settling in December, and I'm so excited.
Okay. So you've got to sell one
I'm
to move
stressed.
into that one.
Yes, I do. So I am going to have a big capital gains bill, but I always knew that with this strategy, that's one of the considerations. So planning around tax, planning around the move, trying to book in removalist bond cleaners, all that fun stuff. So it's been stressful, but I cannot wait. And it means that I'm going to be in the new house for Christmas. And I'm so excited. Kids are
That's fun.
excited.
The kids will be thrilled to be in there.
Yes.
Well, that's good news and all the best with that. It's like the stars aligning or the planets aligning sometimes when it comes to property settlements for people that haven't been through it.
Mm-hmm.
The bank's got to do their thing. The conveyancer or the lawyer's got to do their thing. You've got to do your thing. The money's got to be in the account. You got to get the keys from the real estate agent.
So many moving parts. Yeah, and I have the property that I'm selling and the one that I'm buying settling on the same day. I'm so nervous about this. But something will happen.
Yeah, most of them get settled on the same day that they're supposed to, right? So I have full faith in the system, and I have full faith in you, Gemma. So good luck with that.
What's been happening in your week?
We're doing a lot of recordings, so we're recording some stuff. After we do this here today, I'll be doing the Australian Business Podcast Summer Series, which I'm super excited for because we just had a content day as a team, as you know, here in Melbourne. And a lot of people do know this, but a lot of people don't. Every January, we do our summer series, which is typically the most popular series, episodes, all that sort of stuff that we do each and every year. And this year, we've got a heap of stuff planned. But what's interesting is some of the most popular episodes on our Australian Business Podcast, which is one of the most popular business shows. So if you're a business owner or a would-be business owner, go and check that out. It's green. It looks like the other Rask podcast, except it's green. And what's really interesting is that some of the original episodes that I did for the first ever series back in 2021 or 2022 are still some of the most popular episodes. So we're redoing all of those and kind of giving you an updated take on it. And I remember the first episode I ever recorded for that. Because I did this in my own time because I was just so passionate about it. It was actually the story of Rask, and I went through like the different chapters of our business and all the mistakes and the lessons learned. And that's the episode that I'm about to record just after lunch today. So given the next chapter of that. So redoing the existing one and then updating it, which is going to be really cool. And I like to talk about that, and people find it really fascinating. Like our accountant, shout out to Melinda, went back and listened to that episode yesterday on her way into the office. And she was like, it always brought a tear to my eye how much the business and you had been through to get to where you are. And that's the kind of episode that's coming up first on that series. So that's what I've been doing, just preparing for that sort of stuff. And as you said, we've got a lot of financial advice stuff. Oh, actually, I can actually say this today as well, finally. It's actually core day today. So we're recording this on Thursday. Episode comes out in your time. It's Friday, but it was recorded yesterday. It's core day today. So what that is our membership, Rask Core, which we've promised to roll out and to improve for like over 12 months now. It has launched. It launches today/yesterday. So huge development for our members and for our membership. So the most radical change that we have in place, Gem, as you know, is traditionally Rask Core was a place where you could go and you could get investment updates and research and access courses and all that sort of stuff. The big change that we've brought in now, because of our financial advisors, such as yourself, we now have your kind of DIY financial plans inside the Rask Core community. So they're what we call personas, and there's 7 of them or 9 of them. I can't remember off the top of my head. But each set of characters or character has their own financial plan. So the first one we're launching with is Alex. Alex is a time-poor professional who earns a good salary and wants to get his life in order financially. And what you do is our financial advisors go through and they build the story of Alex. And they give him a financial plan, do his cash flow, which super fund he should go with, what strategy he should use, what ETFs he should buy, how he should structure his bank accounts. And then the financial advisor that leads that persona comes on and does a webinar for our community that might be following Alex and answers questions about what Alex should do next, or Alex is getting married, or Alex is going overseas. Where should he put his money? Should he use an offset account? Like all that stuff, that's what the personas are, and they're amazing, and they launch today, and there's one launching basically every 2 weeks for the next few months. So if you want to be a Rask Core member, it's just a monthly subscription, and you can DIY your financial plan. General advice only. That's what I'm excited about, Jem.
That is very exciting. And there's literally something in there for everyone. There's so many different scenarios that these clients have.
Yeah. So it's like there's like retirees and stuff.
Yeah.
You're doing one, aren't
Lisa's a
you?
divorce lady. Yep. I had
Yeah.
Lisa.
Does she read The Money Reset?
Yes, she does.
Yeah.
She highly recommends it.
So when someone clicks into Rask Core and they go, oh, Lisa, okay, that's the one that Gemma did. And it's just the strategy is just a copy of your book.
It's like the Amazon link and it just says do this.
That's great. No, but the Rask Core is huge. And yeah, we have over 4,000 members in there. And this is going to be the biggest set we've done with it for years. And so shout out to Sophie, Emily, Mitch, Becky, all the advisors. Yeah, it's huge. So check it out. Yeah, you can always cancel your subscription if you don't like it after 1 month, but I think you'll love it. So check it out. We'll put a link in the show notes. Now, we do have some questions to get through, and we'll try and power through them. We know, as my dad used to say when he played soccer, it was a quick game is a good game. I'm like, is it? But anyway, for podcasts, it is.
Soccer always the same amount of time.
Yeah, it kind of is, right? But I don't know what he meant by that, so I'll follow up with him. But any of the questions... Yeah. Any of the questions that we do answer today are strictly general in nature. We don't know your needs, goals, or objectives, so be sure to reach out to a financial planner before you act on the information in any RAS podcast. If we mention super funds or these types of things, they typically have a product disclosure statement or PDS. The first question is actually about a super fund, so that will have a PDS. You can head to the provider's website to find the PDS and determine if it's the right thing to do. One thing Gemma and I always do, and Gemma's the queen of superannuation, as we know, you do not change super funds until you have reviewed your insurance. That's way more important than paying a tiny bit less in fees or a tiny bit better returns. The insurance is so god darn important, and everyone should not change super funds until they seriously consider this. So don't do anything until you're certain. Anyway, there's an FSG on our website, Financial Services Guide at rask.com.au/FSG. Super question comes from Super Anxious. They say, I understand Rest Super has 0% fees on its indexed Australian and overseas shares options as it invests through Macquarie True Index Equities Fund. What extra risks does this pose, and should I be wary regarding investing in such a scheme given the recent super scams? So... Gem, you asked me about this. I'm happy to answer this one if you want.
Yeah, definitely. So you are all over this one and explained it to me, which is great. The only thing that I'll say here is just keep in mind that you're still going to have administration fees for Rest. So it's not, zero fee. It's Rest as a administrator for you. You'll still have a member fee there, a fixed and a percentage, but the the investment that you actually choose in this case is zero. Yeah.
Yeah. So very important distinction. We did an episode recently, one of the most popular episodes of the year, which is we compared super. We did an episode like how to boost your super. It's got like 50 or 100,000 people watched it on YouTube. And I used Host Plus and Australian Super to explain differences in fees. And there's the fee that you pay with like an admin fee of like $2.50 a week or something. It's nothing. Then you've got the fee that's for the investments, and they aren't actually shown in your account all the time. In fact, most of the time they're never shown. And that's the thing where you pay the most in fees. But sometimes, as we talked about in that episode, fees are good. Now, this thing, which I'm bringing up on screen for anyone that's watching, this thing is actually very, very different. So what actually transpires is when you invest with the Rest Super in this instance and you select this option, is Rest then goes, great, thanks for your money, Gemma. We're going to put this with Macquarie, who's going to invest it for you, right? Pretty simple. This thing that they actually invest in is called True Index, and it falls under their branch of systematic investments. What actually happens is this. You're the investor, I'm Macquarie. You give me your money, I guarantee your return. I say, you're going to get whatever the stock market does, that's your return. But if I do better than that, I'm going to keep the rest. Thanks. And that's it. And you're like, oh, okay, Macquarie, pretty big brand, really good business, and sweet. Okay, I trust them to do that. And from Macquarie's perspective, they're like, those suckers over at BetaShares, they're only getting 0.04% on their Australia 200 ETF. And Macquarie's like, I could make a lot more money from this. So that's what they do. So that's basically how it works, is they basically say, we give you the index return. There's no there's no fees, and you get the returns for no management fee on that investment option. And then Macquarie makes money in different ways. So they have a bunch of different things here, but to kind of cut through the mumbo jumbo, they say when the client is investing their money in True Index, they give a True Index swap agreement. So basically they use a derivative contract to guarantee you that return. But in the background, what happens is all of the excess return kind of gets invested behind the scenes. And it's good for Macquarie. They don't, contrary to what many people do think about Macquarie Bank, it's actually not a charity. It's a bank. So they know how to make money. And that's why they call it the Millionaire Factory. But what about the risks? So this is a good question. For me personally, when you look around the poker table, you like to know who the patsy is. I like to know that I'm paying fees. If my financial advisor was to come to me and say, you know what, guys, don't worry about it. You're not going to pay anything. I'd be like, what? So I would prefer to just pay a fee to someone to do something. Or if you go to the doctor and they're like, don't worry about it, I gotcha. You know that they're going to be paid some other way, and I don't like that. So I would just go with something that I feel more comfortable with, and I would just go with, the one that you get charged a fee for, and you know exactly how it's paid. I'm not saying that this is risky. I'm just saying that if you're comparing zero fee versus 0.04% fee for like a beta shares ETF, just as an approximation, they're not the same thing, but just as an example, does it matter?
Yeah, I think people get so fixated on fees, but I think the key thing here is because it's offered in REST, I don't think there's another index option. So I wouldn't, if this is your option and this is what you want to invest in, I'm not thinking it's overly risky from a dodgy perspective. Like REST is a huge brand. Macquarie is a huge brand. They're both very regulated. So when they referred to the recent super scams, I don't put these two in the same category at all. But that's my, risk.
Oh, yeah.
Yeah.
No, they're not at all the same thing. So that scam was because the whole system, that not the super fund, but the actual investments inside the fund were dodgy. And that was by dodgy advisors. It's not, this is not at all in any way the same thing. This has actually been going for a very long time. I'm pretty sure this has been going for well over 10 years. Yeah, it's been going since 2003.
Yeah.
This is before most of the people even listening to this were born. So, no, I'm kidding.
But if I was
most of us are a bit older.
I'd get really, really clear on, do you want to be in like Australian shares, overseas shares? How much do you want in there? Do you want to be more diversified with one of their other portfolios? And yes, maybe they have a fee, but I'd be picking the one that suits you, not the cheapest.
Yeah, cool. The next question, which is from Keen Bean. It's quite a long question, so I might just break it down. It's a question about financial advisors. My husband is seeing a financial advisor for investing. Currently have 145 grand in investments through the platform Expand, which is managed by our advisor. We're happy with it, and the growth is good. However, the advisor can sometimes be frustrating. Often it takes months for them to action changes from our meetings. If I ask questions about super or investing for our kids, I have to follow up a few times before the information is given. My question is, how long is a reasonable amount of time for simple statements of advice to be provided and actioned? Am I being unreasonable for expecting quicker action? Thank you. Gem?
I have a few thoughts here. So one of my thoughts is how much do you need that actual advisor for that portfolio? Like, what else are they doing?
Yeah.
So I'm kind of like, do you need an advisor for that much? But if you are and you're getting a lot of value out of it, they're doing lots of other things for you, it doesn't really matter the amount, right? It's the value, but you're already questioning that. So I think regardless of the time frame, it needs to be communication with your advisor. Like if it's going to take them 8 weeks, that should be fine. Just tell you, keep you updated. So I'd be more annoyed with the uncertainty around different things than how actually long it took. So I would say most advice firms, if you're an existing client, could probably do a simple SOA within 4 to 6 weeks. But regardless, if it's 15 weeks, just tell you. That's what I'd be annoyed.
Communication. Yeah.
Yeah. So I'd be like having a conversation with the advisor on what's the value of us actually working together, what's a realistic time frame for communication and stuff like that. Like sometimes it does take 5 days to get back to somebody, but you should just be aware and not wondering.
Yeah, good point. So people should understand that in the industry, we call financial plans an SOA or a statement of advice. It's like a big document like Microsoft Word or Google Doc, and it's like typically dozens of pages, and it outlines everything in your financial situation.
And lots of disclaimers.
Lots of disclaimers. Ours don't have that many, but we meet the minimum for the disclaimer section. But the important point to understand is what goes into that can sometimes be a lot. Like you have to sit down and do a goals session. You have to fill in a risk profile questionnaire. You have to supply your super information, your tax information, all of your current investments, all these things. And that all gets analyzed and put into that. It's a legal document, and that can take time. So what happens is there's another document called an ROA. This is a record of advice. And this is where your financial advisor can give you lesser amounts of information in a document. And it's only specific to like maybe some changes in your portfolio or something like that. Those documents are typically, a few pages, and they're not changing everything. It might just be like in this person's situation, it might be like a tweak that you've requested to the portfolio or something like that. That really shouldn't take that long because it doesn't require the full process. So it depends what you're asking. Like if you're saying, yeah, we use them for investing, and then you jump into a meeting with them and like, so I want to invest for my 5 kids and my 8 grandkids, and I want to set up this trust and do all that. That's going to take time. So just be realistic with that. But as Gemma said, the communication is so important. We don't, just as an FYI to everyone that's listening, if someone was to come to us with $145,000 of investments, we're probably not inclined to put them on one of these platforms and have us manage it for them. Sure, you can go to our Rask Invest platform and invest with us and we'll manage it, but it's not personal advice. You can transfer.
And it's not like you're not paying an advisor and
Yeah, there's no like thing like that. You can transfer your shares in and out or your ETFs in and out of Rask Invest. But like it's not, you want to start to, if you're only going to them for investing and they're only investing $145,000 for you and not your super and all those other things, you might want to just question what the ultimate fees you're paying are. And if you're not getting the service, just shop around.
Yeah, because like if the financial advisor's doing lots of stuff, your super, your contributions, your debt, your overall, I think that's really valuable. But yeah, I'd be having a chat with them and saying, can we set some pretty clear expectations around it? That's a totally fair way.
Yeah, you're paying for it. So for sure. Geared Up writes in and says, how do I reassure my skeptical, risk-averse family who have experienced significant investment losses that our long-term wealth invested in broad ETFs will not be wiped out by a major market crash like the GFC right when we need to access the money? How do you convince someone that, hey, we need to invest because it's good for us in the long term? And yes, things can go down in the short term, but it's still the right thing to do. How do you do that, Gem?
Yeah, that is a really, really tricky one. So having conversations about money is tough, but also, people that have gone through different experiences, they're going to have very different outcomes, like on how they're going to manage money going forward. So if they've been burned before, I completely understand. I think education is going to be really critical here. And maybe it's actually that you outsource this. It's talking to a financial advisor. It's talking to a money coach. Sometimes, and I actually get it all the time in couples money coaching sessions, it's like when you hear it from somebody else that isn't your partner, it can sink in a little bit more. So I would kind of go from that angle, but just being really kind with them as well, and understanding that if that's somebody's experience and our money, money is tied to so much of our security, our self-worth, it's a big deal to get over things like that. And investing, it's a big learning curve as well. So be patient with them, but maybe outsource. But then the other question I was like, who is the family? And does it actually affect you? So if it's a partner, obviously you need to be on the same page. But if it's like someone removed from you and this is your money, then I'd be like, oh, I don't really care what you think. But I'm assuming this means it's shared money. You all need to be on the same page.
Yeah. It's very common, this concern, isn't it? We deal with a lot of people, whether it's personal advice here in the community, on the podcast, whatever, where one person is the predominant person that deals with the money and the other person does the other life admin. I think that one of the keys that I've realized to unlocking this in people's lives is exposure. So that minimum amount of education can really go a long way. Chances are people in the GFC that were invested at the time didn't actually know what they were doing. And the reason that they lost a lot of money was because they either trusted someone who was a bit crooked or they didn't know what they were doing and they got themselves in hot water. But nowadays, you've got podcasts, you've got even some stuff on social media, you've got YouTube, you've got online courses like ours are free. You can encourage them to do this and expose them to it. Barefoot Investor tried to challenge us in a different way. He did barefoot date nights. And so you would go to the pub or go to a place that they're happy to go to, and you say, it's on the proviso that we talk about some of this money stuff. And you don't just launch straight into, there's nothing more frustrating when someone's not into finance and the other person's like trying to just launch straight into, and this is how much we're going to budget, and this in the spreadsheet, and what do you think about that? Like, they don't care. They're going to turn off as soon as you talk about that. So start with something that's a mutual interest or just their interest, which might be like, hey, I know you said you want to go to Italy next year. It's going to cost us this much. I really want to go. I know you want to go. How are we going to afford it? Like, what can we do? And it's problem solving on the fly. That's a good way to do it. Same with investing. It's like, hey, jump on the Money Smart Super Calculator and be like, this is what I think we're going to have. Like, if we do this little extra bit, this is what the difference is. Is it worth doing that? Can we find that in the budget?
Yeah.
You know, those types of exercises that you can do where there's like a shared benefit and mutual interest, those are the kind of ways to unlock it. But it's hard. And sometimes, like, we've had people crying in the office when they talk with their financial planner because it's the first time they've talked about it in 40 years. So you're not alone. Good on you for giving it a crack. Next one, second last one, comes from FH, snake emoji, as in FHSSS. If you put money into the First Home Super Saver scheme, but for whatever reason you become ineligible to use the funds, for example, you inherit a home or have a house in your name and no longer qualify as a first home buyer, do those funds just get added to your normal super, or what happens with the other options? Like, what other options do you have? Thank you. So we have done an FHSSS, a First Home Super Saver Scheme episode. You can go back slightly in the archives, maybe 2 or 3 months, and you will find it there. Gemma, First Home Super Saver Scheme. I put my money into super to save for my first home. Then out of nowhere, my Nigerian prince of an uncle gives me a house and I'm no longer eligible for the super money that I just put away. What happens?
This is a great problem to have. Before I answer that, I just want to admit I'm slightly embarrassed that I only just got it when you said it, what the snake emoji was about. I was like, that's so random. That makes a lot of sense. I was like, okay. Was having a blonde moment. Okay. So the First Home Super Saver scheme is how we can tax effectively save for our first home, but there is a lot of eligibility that you need to hit for it. So in order to be eligible for it, to actually get the money out. So say you've been doing this for a few years and you've been putting extra contributions into super, you actually need to apply to the ATO for a determination for them to approve you to get that money out, because it's just like this, the super fund seeing it just as normal superannuation contributions, right? So you actually apply and say, ATO, hey, I've been doing this. This is how I'm eligible. So if you are eligible at the time, you do the determination and they say, yep, you can have it. I think you've got like 12 months to take the money out. So if you are eligible and you got the yes because you didn't have the property and you'd already had the yes, you can take that money out. And if you don't use it for a house, it will just get tax adjusted. But if you haven't yet applied and got that yes from the ATO and then you got a house, you won't be able to, because you won't be eligible for them to actually approve it because now you own a house. So in that case, it will just stay in your super as if it was just extra money for your retirement, and future you will be loving you.
Okay, so maybe in the case of a Nigerian prince or a long-lost uncle in Scotland that has a castle or something like this, we can maybe be a bit more relatable. So say, for example, your great auntie is leaving you the house for whatever reason, and you kind of know that she's not doing too well, and, you know, there's a timeline. You might be inclined to go to the ATO and request a determination now for any money that you have put away in the First Home Super Saver scheme and be like, dear ATO, I meet the criteria, blah, 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 blah. And then you can always be like, oh, Aunt Susie is regrettably passed away now. I will take the money out. And then before I get the house, then, you know, I've got my money and I'll just get the tax adjusted through my accountant.
Yeah.
Okay.
But also, I'm thinking, if you just got a free house, leave the money in super. So
Yeah, true.
you might just go, oh, this is a win-win. This is a win for us right now, and this is a win for retirement. But yes, it is potentially you are able to do it and have the tax adjusted. But yeah, if you don't want to stuff around with that, you could just leave it in there, and now you're a homeowner with a healthier super balance.
I guess another thing too is probably one that people should be more mindful of, Gem, is if you use this first home super saver scheme, and I'm assuming that a lot of people would be in their 20s and 30s doing this, and then you meet someone, you get married, and they already have a house, and then you moved in with them, does that affect your eligibility criteria? Is that something that you should be aware of and start to be a bit more proactive and be like, I'm pretty serious with her. I should probably take this money out now, huh?
But if you haven't been on the title, you're still a first homeowner.
Yeah, but we're pretty serious and I might go onto the title soon. So these are the types of things that you should be questioning, whether or not maybe in the near future I will be ineligible. So I should probably move now.
Yeah. And this is why any time we make a financial plan, we're working towards a strategy, like we're working on a strategy. We have a strategy. We want to be reassessing it like every single year because it might make sense at one point and it might not. And, it might not be that you even withdraw it. You just change your strategy and go, I'm actually not going to put any more into it because I don't know if this is the right way for us to go. Or it might be that you save in your bank account and then once a year, you decide if you're going to put that $15,000 into super, but you haven't been doing it regularly. You've done it a different way, just that kept your options open a little bit longer. So there's lots of different ways to do this stuff, but the most important thing is for you to know your goals and what you're trying to achieve and what could potentially be, little detours along the way.
Cool. Final question comes from Doors Plus, which I think is a brand that sells doors.
Yeah, because a little song just went off on my...
What a jingle that was. Yeah. Doors Plus, no fuss. We need that same person that built the Doors Plus or made the Doors Plus, no fuss jingle to write into us because we will use that, something like that for our intros. Doors Plus says, what does it mean to know the cost of opening your front door? So people often say this, the cost of opening the front door. What does that mean, Jen?
Yeah, so I did an episode a few months ago with Jackie Clark, who wrote the book Stop Worrying About Money, and she has a whole chapter in here. And I hadn't actually really heard it referred to that way before, but she does. So really what it is it's your bare bone expenses, the absolute basic costs, true costs for you to actually live, like before you even leave the house, just for you to exist. So think of just your bare bones budget. So this is not your Netflix and your gym membership and all of that stuff. It's your insurance, your car, your house,
food,
rates, all that kind of stuff. Like for me, kids' costs, education, might be daycare, but it's literally just your expenses to live.
So that's kind of like if you took the budget which you hate, which is the 50-30-20 budget, where it's like you've got three categories, you've got the needs, wants, and, savings. This is kind of the needs. You need to pay for these bills every day. Yeah. And that's why people with that live in expensive suburbs have a higher cost at the front door than people that maybe don't live in those suburbs, or people that have a flashy car on a personal loan or something like that. They might have a higher cost of just opening the front door. That's cool. Go back and check out that episode with Jackie Clark. So we've had a question from Super Anxious about Macquarie True Index. Well, maybe just explore other options there are if you're worried, because you got to sleep at night. But also, Macquarie's True Index has been around for a long time. Keen Bean asked about the tardiness of a financial advisor. Sometimes it does take a little while. Our financial plans, the new ones are taking 2 to 3 months at the moment because that's just how long it takes when you're under the pump.
Communication is key.
Communication. We'll tell you how long it's going to be straight away. Geared Up says, my risk-averse family, it's about education. It's about examples. It's about just speaking to them, immersing them in it, maybe getting someone else in the room. Come to a Rask event in 2026 and just let them see that other people, you're not the only weirdo that talks about finance. There's like 300,000 other people that do as well. FHSSS talked about the first home super saver scheme and what goes wrong along the journey or could go wrong in your plans. As Gemma said, just check in with yourself every now and again. Doors Plus, the cost of opening your front door. I don't think I want to calculate this figure, to be honest with you, Gem. I think it would probably make me anxious.
It probably would. Mine's about to change. I can't wait to do. We know that I love a budget and a spreadsheet, so I already have one of what I think it's going to be in the new house. But I can't wait till it's like all the loans are settled and everything's done, and I just get to redo everything for the new year. I'm such a nerd. I'm excited.
I like it. Well, this is the Australian Finance Podcast. That's where we talk about finance. So if you're new here, you can subscribe. Just in any of your podcast players. Approximately 60% of people listen on Apple Podcasts. I think, that's of the audio only. Increasingly, more and more people are watching on YouTube, which is fantastic. So hello to everyone on YouTube. And if you're on Spotify, lonely old Spotify, don't forget that if you are a regular listener of this podcast, you may also be able to, as a pro tip, go back to one of the authors that have been on the show and see if you can get some audiobooks from one of the authors for free. So check that out. It's all available now. I think you can get the audiobook to The Money Reset on Spotify.
You can.
Do you know who wrote that book, Gemma?
I do. I've heard that's such a good book.
Yeah, The Money Reset.
Yeah,
I think
the author actually narrates it too. So if you can stand listening to me for 35 minutes on this podcast, you can do 6 hours on the audiobook.
But I think that we should actually explain just really quickly for people who have never, ever experienced what it's like to record an audiobook. What actually takes place because we're recording this podcast right now. I've never recorded an audiobook, Gem. If someone's listening to The Money Reset and they can hear the soothing tones of Gemma Mitchell in their ear, what actually went into that?
So this I shared over a couple of beers the other day, and everyone thought it was hilarious. So that 6 hours was actually like 30-something hours, and I was sitting in this little black, dark room and just reading for like 8 hours a day, having and you just drink like this special tea, and there's these special like throat lollies, but you don't just read it like you would read. Like they do what they call drop you in. So they'll be like, oh, back from this word, back. And so you don't actually really ever know where you are. And it's not like it's just flowing, and it's just like stop, start the whole time. It's really difficult. And I'm not I'm a little bit bogan. I'm not very polished. So on the Friday, I had to go back in for fix-ups, and I pretty much just had to say the word genuinely maybe 50 times, genuinely, because they would drop me in, because apparently I say it and it sounds like generally. So I had to fix all that up, but you can't just use me saying it once and put it everywhere. They have to put you in to the sentence and re-record that. So it's like genuinely.
So you had to say genuinely. You had to say it like 50 times in 8 hours.
Yes. And also I realized how much I say it in the book. Yeah. So it was horrible. An audiobook, I would never listen to an audiobook the same, because now I know what goes into it. And maybe I'm just terrible at it. Maybe other people didn't have this experience. But yeah.
Well, I'm going to relate this to in a Simpsons episode where Lisa goes to the abattoir and she's friends with the little lamb, and then she comes back a vegetarian. I still hope that you listen to audiobooks after your experience at the audiobook factory, because it's a really good book. You can check out The Money Reset. It's in hard copy, or you can go and get the audiobook. And a special shout out for people on Spotify, because Spotify premium subscribers get a bunch of audiobooks as part of your membership. So go and use it. Gemma, we're back next week. We'll be answering questions. The link is in the podcast player that says ask a question. Simply select the Australian Finance Podcast. We'd love to hear from you. Bring the funny names. I love the FH snake emoji today. It was really on point. There's a few of them, Doors Plus as well. So Gemma Mitchell.
Emojis in and confuse me for next week.
Yes, keep confusing us. Gemma Mitchell, thanks for joining me.
See you next week.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.